Hey, it's Michael Hopkins at Seeking Alpha, and again, I'm here with Jennifer Warren, who is a Seeking Alpha contributor and also works with Concept Elemental, her company there. Hey, Jennifer, how are you?
Good. Hi, good to see you again, Michael.
Good to see you
For
too.
December.
Right.
Years
Yes,
passing us by.
for sure.
Um,
Just real quick, um, talk about a little bit what you're working on and other ideas, the energy of state of play, some key items that you've been looking at just recently. Anything that you can share in terms of observations?
sure. Okay, so yeah, we're going to talk about a little bit about some of the research I've been doing surrounding an article that's going to be coming out. I'm not sure when. And it centers more on, really, it centers a lot on the energy transition, more so than we spoke about last time when we were kind of recapping the Fed findings. And this is kind of like recapping the Fed findings, but the part that we didn't really get into as much, which is the energy transition and all the the renewables and the storage and all that sort of thing, and how it interplays with oil and gas. But what I've been working on, really gunning it for the last like 12 days, just little sleep, lots of research, talking to a lot of executives, all my usual suspects. And so if before we were looking at this like, on Google Maps, how you're like satellite view, now this is like literally, I feel like I'm like the Google Map person that's just walking and seeing everything. So that's kind of like where my head's at with some of this. But I guess what we can do is, one thing I'll just say to start is that, you know, and this kind of came up in the Fed conference too, that, old fuels don't die out, they just get added to. And so, we think, oh, there's going to be, this decarbonization drive, there's going to be this reduction of oil and gas and coal. Yes, coal is, transitioning more than oil and gas per se. And that has to do with all the electrification issues, that we're trying to decarbonize the grid more. And so we'll just hop into some of these slides because this will help explain it. And
Sure.
then we can talk afterwards a little bit, kind of get more interactive. So let me just make sure this is, oop, I have no place to put my notes and things. I really need a better setup one day. Can you see this okay?
Yeah, I can see
Okay.
it.
Okay, so this is one of the slides that this minerals expert, Morgan Bazillion, put up. And he was talking about more transition issues. And basically what it's showing, if you see here, I think this is oils, this yellow part. And as you get nuclear, as you can see, things just get added onto from 1850. Oh, this is biomass, the red at the bottom, and then coal is the brown, and then oil, gas. So now if we look here, these are all of the minerals and the resources required, to start doing all this, solar, wind, technology, battery storage, EVs, new materials, you name it, we're adding to. There's more minerals requirements. And therein lies the rub of some of the energy transition issues, some of the headwinds of it. And then this is just switching over to something that caught my eye. This is about, because this is a U.S. opportunity, play here. It's the LNG factors. And this is showing Europe. See, this line right here, Russia invades Ukraine. This is in 2022 here. As you can see, we've started from pre-war to post-war, we've started picking up more of the LNG trade with Europe. And I just read today in the Wall Street Journal that Europe's LNG imports are increasing by 34% by 2024. That's the EU and the UK. And so that's a big increase. And as we can see, the Russia part here in purple has, gone to little. And then here is the Russia LNG little as well. So they're going to be importing more LNG. And as a matter of fact, I think like the news was that Germany is trying to bring like 3 LNG facilities online, like quickly, like Herculean efforts to engineer these facilities to get LNG. Well, and here's the US benefactors. These are US LNG terminals on the Gulf Coast, largely here. And you can see all the amounts. And there was this Freeport right here, this sort of teal line that went down offline, but that's going to come back online. And so that's like 2 BCF a day. So those imports will pick back up. So it's very bullish for LNG. And I spoke with a hedge fund manager this morning, and he was saying that I asked him about, sort of natural gas prices. And right now, I think he said it was 150 euros per megawatt for Dutch gas, and they expect it to go up to the oil equivalent of 250. So there's been a warm winter thus far, meaning it's not been hitting demand as hard to, bring those storage resources back down. And then because it's been warm, it's not also doing that interplay of oil, where it starts, requiring more oil. So there's been a pause in the oil demand a little bit, concerns about China in the COVID. I have a slide that's later on. And so that's kind of been tempering some of the oil prices, but the sort of consensus is this hedge fund manager, they were at 85 to 105. That was their range ahead for 2023. Now it's just 80 to 100. So it's not marginally different. So when you're seeing these prices go down, I think the futures today, WTI was like 71. That's not the whole story, and it's not going to stay like that. Now, switching back to the energy transition, this is just a slide that caught my eye. And, this is like in a big green deal where we just decarbonize everything. Obviously fossil fuels go way down here. This is this top left, and then there's this case down here on the lower right, muddling on, where, things just kind of transition. Or then we have this upper right technology breakthrough, and where it changes the dynamic. And frankly, from everything I've been working on, I really pray for a technology breakthrough, just because of the requirements of, this energy transition, the way it's set up right now. But here we are, sort of, this was something that one of the ConocoPhillips executives presented, and it's just talking about how many trillions would be needed, in investment, even if we went to net zero, which is, very much reducing oil here. You would still need, hang on, I sort of worked that out. You would still need 500 billion a year roughly in oil and gas investment. Oil investment to do that. And right now we're like 400 billion. So we're still short. We're still short investment for oil in the reduced case even. So what does that tell you? That tells you that prices, if you keep decarbonizing intensely and fast, it's going to, oil prices will go up. It's going to happen. And then this is all gas. And so it's an unbelievable amount, $4 to $10 10 trillion annually to do net zero. We're not there. We're nowhere near there. And I'm going to show you that in a minute. So this is back to that price range. This was from the Fed conference. Somebody was just kind of at the 80 to 100. So I think Jay Hatfield is the one that had the 80 to 100 range, and he's the CIO of AMSA, the publicly traded MLP ETF. And so again, they've not shaved their oil price forecast down that much. So here's something I've been looking at more deeply. This gets to the crux sort of my article. We'll talk about it a little bit if you want to when we're done here. But this is just showing you all the money that's being spent by our government, for decarbonization, sustainability, greening things. And specifically to energy transition sort of items, it's 260 billion. There's a huge amount, 128 billion for wind, solar, and storage. That's in this power section here. Nuclear, okay, CCS, carbon capture. There's a good bit there, and including hydrogen hubs, which were cited as, and here's some hydrogen hub money over here in an earlier law from last year. Now, one thing that was said at the Fed conference too is that, hydrogen hubs are probably, more doable because, we have all this intensity in CCS, hydrogen on the Gulf Coast. There's all that infrastructure there that could facilitate that. So it's kind of a geographic concentration of this know-how, and the demand, the supply, it's all right there. And this is back to something we talked about last time about, these different scenarios in the energy transition and how much would be required. And we're here on the left, we're spending right now, and this is without all that new money, $750 billion in, green investment. And that's a mixture of the yellow is renewable and the green is electrified transport, which is EVs, charging stations, batteries, that kind of thing. And so more specifically, this is just showing you here. Okay, so if you forget all the blue bar, that's just renewable energy that's happening. Everything on top of this from 2015 to 2021, electrified transport, a lot of money's been spent there. And then you have this electrified heat, nuclear, and just, negligible amounts in CCS and other things as of yet. But that's projected to change. So with all this new money, this green line just shows you the economics of solar increasing here, the economics of wind increasing here in the middle, what the expected, increased capacity is going to look like. And then this is interesting because this gets to my story. So you can have all this solar and wind, but it's intermittent. It's got to be stored, and then there's other factors connected to the grid that I can't really go into because then it would give up my article. But as you can see here, this piece right here, ERCOT, that's the Texas grid. And so there's this expectation. So this darker blue is pre-IRA, before all the money, the outlook, it's an outlook, it's not all happened, right? And they're looking at, I think that's about 8 gigawatts on the Texas grid, and then an expected. This light blue is an additional investments expected because of the IRA, the Inflation Reduction Act, the $260 billion I just mentioned. Okay, so that's supposed to boost things like, double on the Texas grid. The other thing the IRA does, biofuels, cleaner fuels, and that's also, I think there's prospects that look good for that. If you look here on this far left, the renewable diesel production capacity, here in the blue, North America has a lot of capacity projected. And then there's all this sustainable aviation. Now, again, that is this darker blue economic transition scenario. It just means it's gonna happen. It is happening. It will happen because of the IRA money. This light blue is accelerated if we just put the pedal to the metal on decarbonization, which, as we've seen with Europe, probably not going to happen that fast. And this is what I'm learning increasingly everywhere, everyone I talk to, not going to be happening as fast as everyone thinks it's going to be happening. Even with the money, even with the boost. And there are reasons for that, and I can get into those a little bit. And it's my article as well. And then just talking a little bit about carbon capture and hydrogen. So this is all hydrogen over here on the left. And what I can say about that is I looked at BP today a little bit, and they are investing more in hydrogen plays. And there's obviously a lot of different players, chemical players, big chemical firms like Air Liquide and things like that would be, going this direction. I mean, they already do this. And so that's changing the calculus. As far as carbon capture goes, basically all this chart's saying is with the new monies, it's tax credits. It's expected to stimulate carbon capture. The firms that would benefit from this are many, and large oil and gas players are likely candidates to be able to leverage this potential. And here in this area, this natural gas, ethanol, ammonia, everything in the purple are things that are already done by the industry, already happening, monetized, all that. Over here, hydrogen, cement, petrochem, steel, coal, blah, blah, blah. All of that is what gets moving because of the new subsidies, that things that would not have been economic necessarily become economic. So that's based on subsidies. And then it's always that thing of, what's going to stick, right? And this is just a big reminder that, we're a large consumer and producer of oil and gas. China's the largest importer. The US and Europe are not the primary customers of OPEC and Russia, the number 1 and number 3 producers of oil and gas resources. I think we're number 1 or 2. It depends on how you look at it. And then just, back to price outlook. And this is one other quick thing I was going to show you. So this is actually the battery storage thing, because people go, oh, okay, if we're gonna, we can just add battery storage to all the renewables that we expect, and voila, it's going to happen. So right now, battery storage gigawatts. So in 2022, there's just, 8. This is operating. This is all planned. A lot of this planned, I suspect more of it's planned because of the subsidies. I don't know that this would be happening otherwise. I can't attest to that because I haven't looked into that deeply enough. But I'm gonna stop sharing and so did you have anything that was of interest to you relative to your viewers?
No, I mean it's very interesting and it's a lot of detail. And I think the one thing that comes to mind is there's opportunities, but there's also a lot of challenges with this whole transition and moving forward with that. So I guess the question is, what are some of the capital constraints, opportunities with the transition and in light of the new government spending for these initiatives?
Yeah, I mean, it's a vast, intricate topic, right? So we have, I mean, and you have to just break it down real fundamentally because, okay, we have the oil and gas demand that we have. It's all growing. It's growing because of that 50% more energy needed by 2050 because of the developing world. So regardless of what's happening in Europe, demand-wise, it's still happening. Now, what Europe does because of the Russia invasion of Ukraine is that now they are demanding or needing more natural gas, and they're needing it from us, you know, because they're not going to be using Russia's natural gas. And, you know, people could say, oh, well, you know, Putin stops next year and, you know, it all reverts back. Well, Germany's building all these plants. They're spending a lot of money. I think it was like 350 billion, you know, up to 2030 to have LNG import capacity. Those are long-lived assets. Once you plunk those down, they're there and you're going to use them, you know. And so Europe is not going to go back to where it was. I mean, now this is me just, you know, reading the tea leaves, and, you know, they're diversifying, period. Smart. You need to do it, you know, and they have to do it. Now, again, there's the idea that they can produce their own indigenous resources, and that will probably happen. And if anything, my Solving Europe work that we talked about 2 times ago, you know, that there's this entrepreneur, this US shale entrepreneur that's starting to help Spain with bringing online more of their own gas resources. The UK has a ton of onshore shale gas that would rival the Marcellus any day of the week. You know, there's other sources of natural gas in Germany's backyard that are not Russia. So there's a lot of other resource options with that. Now, the US is just a huge benefactor, period, just because of our position, that we've been positioning ourselves for a long time. You know, we've been at this shale revolution, you know, has allowed us the position we now hold globally as a energy powerhouse, a reliable energy powerhouse, a reliable ally, a reliable producer, you know. So there's a lot to be said for that, you know, like George Yates talked about in the article. You know, the oil and gas business is a relationship business on the production side. It's about trust, you know, and so you want those trusted companies, trusted allies, you know, trusted producers. That's a huge piece of the equation. And I think if anything, this Russia-Ukraine invasion shows us this, right? And I think, and that gets to maybe Oh, and just to circle back really quick on the energy transition, some of the constraints before I get off on this Macron visit. Don't forget though, because I do want to say something about that. So back to the energy transition constraints and opportunities. So yes, there's going to be more renewable capacity built. Sure. Actually, a lot of it's happening in Texas. If somebody looks at the map of the US energy resources, they can see where these resources exist, which indicates potential. And a lot of these very large utilities like Vista and AES and Orsted and a lot of those top holdings in ICLN, the ticker that we selected the last two times. Some of those top holdings are definitely going to be in the mix of this because there is going to be increased decarbonized electrification. That's going to happen. It's going to happen partly because of coal being retired more, except in China, because it has to happen just on the pollution front. It's just terrible on pollution, and if you're trying to reduce carbon emissions and greenhouse gases, that's low-hanging fruit, and it has to happen. And so there will be more renewables and there will be battery storage built. That's just on the cards, and like I said, those big utilities. And there's also that Spanish one, I think it's Iberdrola. As a matter of fact, the CEO of the North American counterpart of that means she runs the North America part of that large Spanish utility. She spoke at the Fed conference, and she said that they're definitely bullish on. I mean, she didn't say this, but this is what she meant. She meant that she's bullish on the United States, but we've got to clear out some of these bottlenecks, which have to do with the grid. And it's going to be a slow process, and it's going to cost a lot of money to do that. And ratepayers and taxpayers are going to pay, but it also has to do with upgrading our infrastructure. Anyway, even if we weren't doing all the renewables, there's a lot of aging infrastructure issues, which is an opportunity. There is going to be this upgrading and updating of infrastructure, because one thing she mentioned was that, we have these coal plants in a certain location that are at 20 to 22% capacity. They're 50 to 60 years old. They're going to get retired. And what's going to replace them is natural gas fired power and renewables. Nuclear, maybe. So those are natural gas fired power, renewables, low-hanging fruit, gonna happen. And so in some respects, the renewables push, I don't know, and I don't think it's going to be pushed as hard as we think it's going to be pushed. And that, I mean, long term, because renewables are low density. We need high density in order to run the United States, in order to run the planet, the globe, like it's wanting to be run, adding in all this digital infrastructure, the cloud, more cell phones, Netflix, yada, yada. You're going to have density, and so there's the technology breakthrough. So if anything is going to happen, it needs to be density focused, in my view. So that's where technology can help. And that's even when I was talking to an executive on this article that I have coming out, that they're trying to, they're a big oil and gas firm, and they're trying to, one path for oil and gas firms to reduce their carbon emissions is through electrifying operations in the field. Like instead of, pumping, using power gen that's gas fired or coal fired, they would be sourcing more renewables, solar or wind capacity to become, get to net zero. But that's going to take a while. It's going to take planning. They're having to plan this with utilities as we speak. It's going to be some number of years, and likely on through to the end of this decade, for that to happen. Because also these oil and gas firms, as we know as investors, they got to use their capital efficiently. As much as they want to reduce emissions, that costs money. Reducing emissions costs money, and it's got to come from somewhere. And so you have to be efficient with the capital. Shareholders want dividends now with oil and gas. They want cash returned back. The things we talked about back on the Solving Europe video, and maybe we talked about it last time. So investors expect a return. So that is the ultimate driver too. The government can throw in all this money, and see what sticks, and stuff's gonna stick, as we've talked about, for sure. But at the end of the day, interest rates have risen. Everything costs more. There's supply chain issues. Now, with money actually costing something, the bar is higher for projects to make. But frankly, that's a good thing. We need to slow this down. The net zero push from the last couple of years was a train wreck ready to happen. And now some sanity is coming to light. Now, I don't like one bit that it happened, that Russia's war was a trigger, but it was already happening before it. And we talked about this with the Solving Europe's crisis. Those high prices were already happening with natural gas. There was already cracks showing in this too fast, too soon, too quick green push. It's got to be done smartly. And I'm all for, reducing the pollution on the planet. Absolutely. But I think it's got to be done smartly. And, and I think the market, and this is what's important, I think, for Seeking Alpha people and investors, I think the market is smart. We've talked about that. The market, no matter what the government does, frankly, the market will determine it. And that's based on need, and that's based on companies, and that's based on entrepreneurs, so.
And that might be a question I'd like to ask maybe toward the end of the conversation. But first, I mean, you talk a lot about how the transition's going, and it's going a little fast. And especially, I think this is happening in Europe as well. So should Europe be right to be concerned about what's happening with the de-industrialization? French President Macron's concern expressed in a state visit.
Yeah. No, politics. I know. Yeah. Legitimate concern. When I heard, there was sort of like this telegraphing that he was going to be talking about this, right? And he raised it obviously with Biden. I saw the 60 Minutes interview. I've read a little bit. Now, here's the thing. So Europe has had their own policies before we, did this IRA legislation, this new green legislation. Europe had these carbon border adjustment mechanisms. They had their own green industrial policy going before us. Now, Russia happened and derailed a lot, right? Derailed a ton, changed the calculus on their plans, right? And started changing their energy mix very quickly in some respects. I mean, look at how fast Germany's having to build LNG import facilities. They're going over insanely high hurdles really fast. Hats off to the Germans. That's cool, what I think they're doing. But de-industrialization, strong word, a bit inflammatory. Even before the war, there was already movement here by large firms, and oil and gas is a proxy, because of our energy powerhouse resources, because we had all this laid out, because we have one of the freest markets in the world, because our markets work, because we have transparency. There are all these factors connected to why people want to do business in the United States, and it's, like I said, it's just a freer market, whereas Europe has been known to have a lot of hindrances in terms of regulation, and so businesses have done the calculus. Now with the Ukraine invasion and Russia changing things, crisis, right? Creates a crisis. And so it makes what we're doing look like, oh, we're just going to grab everything. But you know what? It's okay. It's $380 billion in total. It includes some manufacturing, because there was the chips bill. There's been three, basically. And all that was done to redress the China imbalance. Basically, it was, a lot of it's done so that we're not dependent on China for all our critical minerals, and solar panels and all this stuff. So it was done for a certain reason, to redress that imbalance. Nothing against Europe, but Europe probably feels like, oh, that big dog's tail's swinging and hitting us, right? and yeah, it probably hits, but it's not the whole story. And I know that they're going to try to work things out to make it hurt less, but a lot of it was centered, from what I read, on EVs, the EV subsidies, the parts, the sourcing of all that. So it's very, so if you're just talking about EV specific things, in Germany's EV, creating, manufacturing EVs and hitting that, well, that's just a subset of things. And frankly, the EV story is also fraught with some perils and obstacles. And we've discussed this. It has to do with the charging stations. It has to do with a lot of things. It has to do with the cost of EVs. It's, again, something that Jay Hatfield and I talked about too, is hybrids really make a lot more sense than EVs. You still want to have access to a tank, and fine, plug in some and, do that. So jury's out on an EV world. And if EVs are built on all these subsidies, well, that's not going to work. There's just not enough money in the world for that to work. So deindustrialization, that's a big thing, all this industry is not going to just rush here because of this $368 billion. It's a little bit of a drop in the bucket, frankly, in terms of real money, relative to those trillions we were talking about, right? Yeah, it sends a signal. Okay, the US is open for all this green business. Okay, and the US is business friendly. So it does that, but you know, that's the issues. So that's a whole policy issue. That's a whole rethink for Europe about, how we're going to approach business, and how we're going to attract business and how we're going to partner, because collaboration is key in this energy transition. We can't do it alone. Carbon emissions affect everybody. It's planet wide, and with the geopolitics in the world as such, if anything, we know that we need to do business with our friends, and so I think, instead of looking at it like a problem, maybe it's a good problem to have, and we should embrace it and figure out how to work with it. I don't know.
Well, I mean, it's obviously a lot going on. You see, while it's very challenging, it can be an opportunity. And I'm thinking, what are the scenarios that you see as potential investment sources when you see this opportunity that's out there for this?
You mean places to put money, basically?
Yeah.
When you,
yeah.
yeah.
Something to think about right now. I mean, especially, maybe it's not the right question, but
No, I mean, that's what you're getting at, right? Is that what you're asking? So what are some, what are some places that would be, good places to look for investment? Well, definitely US oil and gas. And we've discussed that before,
yeah.
leading firms, doing smart things, again, the setup is good, for a lot of that. These oil and gas, US oil and gas firms, even majors, are, offering good dividends, good returns. They're paying down debt. BP talked about that they're going to be, spending, they've done quite well in their last quarter, and their capital expenditures are, X, and their, income, or their, whatever, the revenues are like this, and they are, and they're going to be paying dividends. They're going to be buying back some stock, and, it's looking pretty good for oil and gas for a while, and as far as the renewables go, I would personally, I like some of the bigger players that are established, and I think those are worth watching. I think I would look at the holdings of iClean, for some clues, and just look at who's doing smart things that have a model that I would not factor in all the subsidies, frankly. If something is subsidy driven, for me, I don't like it. I'm not going to put my money in that basket. And so, if it's just a little fraction and maybe it helps them figure out some new technology area, like with CCS, carbon capture, okay, as long as they're being smart about it. If they're just tossing money into the wind with it, that's not a good recipe. And, we see some of that, but I think that's changing. I mean, you can't be doing the projects you were doing 3 or 4 years ago, not with capital costs the way they are, so, and I'm trying to think if there's anything else. I like, okay, so BP, for example, they're trying to become more of a integrated energy company. That's their direction. And in looking at their presentation, so they have, here's the oil and gas that, we're going to do. I can't even remember the term, reliable, efficient, whatever, good oil and gas. Here's our, consumer and mobility area. And then there was one other, I can't even remember. It's in that genre. And notably, more of their projects were in the good guy oil and gas camp, as opposed to the other. And so I think you see this little bit of a, ooh, we got to tweak this a little bit, and Russia did that, right?
Yeah.
Russia changed all of this, from gangs, guns a-blazing green to, oh, you know what? Geez, these oil and gas assets, these are a pretty good thing, so you can tell I've been like doing all this Texas oil and gas work and energy transition. I've been in the weeds with people on the land. It's been fun. But
Sure. I mean, and I think there's, again, with US companies, especially, I think you alluded to this at the beginning, it's important I mean, there's opportunities here for US firms, but it's also, it seems like to me, it goes back to the whole geopolitics thing. It's important to have these partnerships in place to make sure that, I guess, really Europe and other places in the world who don't have the energy resources have the resources that they have in place. It just comes back to geopolitics, it seems like, with this conversation.
Well, and also, if you think about it, I mean, look at the multinationals. A lot of those big utility firms that I just named, they're European. Their HQs are in Europe, and they're doing things here. They're doing more here than there. And I think that was one thing. I know Macron had he invited a bunch of big energy players to the palace and, basically said, stay here, don't go to the US, and, that's a whole nother story. But yeah, but the bottom line is, we are in partnership, and we're going to continue to do things, and firms are going to they're going to listen to their shareholders, and they have to make a return at the end of the day. That's their key stakeholder, and governments can sweeten the pot, and they are, but at the end of the day, you still have to have a business model based on the market. Right? What is the market? What is in demand? Energy is in demand. We talked about this, with that solving Europe's energy crisis. Energy is fundamental. It's critical. Look at Ukraine. They just got so much of their power infrastructure bombed out. For God's sakes, that's not going to help anything. I mean, it's just hardship all the way around. It's lives, it's everything. So energy is critical. And so these firms, even these large European, multinationals, US majors, all of them, they have a duty to provide this much needed resource at the lowest cost. They got to take care of shareholders, and so it's a bigger imperative than just a government policy that can change in 5 years or 3 years. I mean, it's fundamental, and it's longer term. So that's, I think, when I'm looking through my energy prism, that's the thing I'm looking at, is who's here to play and who's here to stay, and I definitely have my firms that are my go-to firms, and then I have my firms and I'm like, oh, I'm going to try this out and see what happens, my experiments, but they're calculated risks, based on knowledge, so
I think that one thing to think about with all these videos we're doing, it's that long-term message that comes out. I think we've done 3 of these now, and it's just like, well, we have all these moving pieces. You have the constraints, but also the opportunities. It's this long-term situation in terms of addressing all these issues that we bring up.
Yeah, well, and if you're investing for your retirement, you don't know how long you're going to be in retirement for. Is it 10 years? Is it 20? We're living longer. We're managing our own money more. We have the opportunities to manage our own money more. and actually we're having to, because we don't have as many defined pensions anymore. You know, it's defined contribution. You got to figure out what fund to put your money in, you know, and then a lot of people just put it in there and forget it. Or you are you're more active in your management. And I think that's what Seeking Alpha allows, is people to have the information they need, or that, you know, as much information as you can get, you know, that's publicly available. And I think that's what I think that's why I want to do what we're doing, Michael, is because the information playing field, you know, needs to be leveled as much as possible for every man and every woman, every child. You know, and so, you know, if I can help do that, you know, and I've said this before, you know, my role as an information intermediary, I'm not beholden to anybody. I'm not at the mercy of media relations of some firm or some investment firm. I can pretty much, you know, be objective, you know, and so this is a good place to do that.
Well, we appreciate that. I don't have anything else unless you've got something you want to add.
That's all I have up my sleeve, Michael. And
Well,
I don't know when my article's coming out, but it is delving into the intricacies of the energy transition, you know, with all the resources we have, you know, and then renewables, what the constraints are, you know, some of them that are hindering that progress. And but definitely I think what we talked about today helps fill in some of the gaps with the subsidies, the money, the policy that is getting so many, it's getting governments, you know, interest peaked, you know, and investors and firms, and everybody's really excited about it. And it's great, you know, but I also just kind of look at it with a, you know, sitting back and,
yeah, right.
you know, what's really going to happen, maybe.
Yeah.
So,
Well, I'm looking forward to the article. I mean, it's going to be when that comes out, that'll be exciting. So,
yeah.
Jennifer, thanks for the time.
Thanks a lot. I'm sure we'll talk again, Michael.